All right, so we've got a pretty hefty stack of financial engineering material here. Looks like you've been doing some serious research.
Yeah, well, I find it pretty fascinating.
Yeah, there's like textbook excerpts, journal articles, even some of your personal notes. Looks like you've been really diving deep into options pricing and stochastic processes, all that fun stuff.
It's a pretty amazing field where, you've got this intersection of really complex math with, the unpredictable world of markets. And it's not just about crunching numbers, right? It's about using those numbers to like really understand and even create new financial products.
Yeah, I thought we were talking about today financial engineering. It's where Wall Street meets advanced calculus. And judging by these notes, I mean, you've been digging into some pretty complex stuff. I'm especially kind of intrigued by all this focus on options pricing models. It always seems so mysterious to me.
Well, you really can't talk about financial engineering without talking about the quantitative core, right? It's all about using mathematical models to make sense of risk and try to manage risk in a world where things are constantly changing.
Okay, so let's break this down a bit. You've got stochastic processes highlighted all over your research here. Can you give us kind of a crash course? Like, what is that all about?
Imagine you're like trying to predict where a single piece of confetti is going to land in a windstorm. It's unpredictable, right?
Yeah.
Financial markets, they're kind of like that too. Stochastic processes give us a way to model these kinds of unpredictable systems, these randomly evolving systems.
Ah, okay.
And it's not about trying to predict exactly what's going to happen, but to get a better sense of, what the range of possibilities might be.
So it's less about like finding the answer and more about understanding all the different paths an asset's price could take.
Exactly. Financial engineers, they aren't fortune tellers, right? They're using these models to sort of assess probabilities and manage risk, not to say like with certainty this is exactly what's going to happen.
That makes sense.
And that's kind of where things like derivatives come into play. I mean, you've got a whole section here dedicated to derivatives.
Yeah, derivatives. I feel like that's a word that gets thrown around with a lot of fear and misunderstanding. They even played a big role in that whole 2008 financial crisis, right?
Yeah, they did, and I think understanding how they work is really key to understanding a lot of what goes on in modern finance. Um, at their core, derivatives, they're basically financial contracts that get their value from some underlying asset. So we're talking like options, futures, swaps, things like that.
Okay, break it down for us. What are these things and why should we care about them?
Okay, so let's start with options. An option, it basically gives you the right, but not the obligation, to buy or sell something, an asset, at a specific price by a certain date. It's kind of like, putting a reservation on something, a potential purchase, giving you some flexibility in a market where things might be moving around a lot.
So if I think like, a certain stock is going to go up, I could buy what they call a call option.
Yeah.
And that gives me the right to buy it at a certain price later, even if it goes up higher. But if it goes down, I don't have to buy it.
Exactly. You only exercise the option if it actually turns out to be profitable for you. And
Right.
that ability to kind of, manage potential losses is a big part of what makes options valuable for hedging risk.
Interesting. Okay, what about futures contracts? Those sound a little scarier.
Futures contracts, those are a little different. They actually obligate you to buy or sell something at a predetermined price in the future. A lot of times, businesses use these to sort of lock in prices, say for commodities or currencies, to protect themselves from unexpected price swings.
Got it. So futures are about certainty and options are more about flexibility. And then we have these things called swaps.
Right, right. Swaps are agreements to exchange cash flows, and these cash flows are based on different financial instruments.
Okay.
So, for example, a company might want to swap a fixed interest rate for a floating one, as a way to manage their debt costs. It's all about kind of customizing your exposure to risk based on your specific needs.
It's fascinating how these derivatives can be used for like, speculating, but also just for managing risk.
Right.
You mentioned the Black-Scholes model in your notes.
Yeah.
That's, a really important thing in options pricing. What's so special about that?
Well, Black-Scholes, that was a real game changer. It gave people a way to mathematically figure out the price of an option, taking into account things like the underlying asset price, how volatile it is, and how much time is left until the option expires. Before that, it was much more guesswork.
So it's like a formula for figuring out the fair price of that reservation we were talking about, that option to buy or sell later.
Yeah, Exactly. But even the best models, there's still simplifications of reality.
Right.
The Black Scholes model, it makes certain assumptions, like that volatility is going to stay constant, which isn't always true in the real world.
So it's a powerful tool, but it's not a crystal ball.
Exactly. It's a starting point, a way to kind of frame the problem. And financial engineers need to understand, both the power of these models, but also their limitations.
Okay, that makes sense. Speaking of understanding limitations, you've got a whole section here on risk management.
Hmm.
It seems like financial engineers are, they're almost as much about preventing losses as they are about making profits.
Oh, yeah, absolutely. Risk is just inherent in finance, right? And financial engineers, their job is to try to, well, to identify it, to quantify it, and then to try to manage it. And it's not just about, that basic market risk of investments going up or down.
Right, right.
You've got, like you mentioned here, market risk, credit risk, operational risk, liquidity risk, all these different flavors of risk.
Yeah, let's try to break those down a little bit, for people who might not be super familiar with all the jargon.
Sure.
Starting with market risk, I guess that's the one most people think of.
Yeah, market risk, that's the risk that your investments are going to decline in value because of, changes in the overall market. Could be interest rates, could be just general investor sentiment, whatever. It's what we usually oversimplify as buy low, sell high, but it's a lot more nuanced than that, really.
Right. And speaking of nuances, you've highlighted volatility a lot in your notes. How does that fit into the picture?
Volatility, that's a measure of, how much an asset's price is jumping up and down. So like a highly volatile asset, think like a tech stock, it's going to have much bigger price swings than something that's less volatile, like say a bond.
Oh, okay.
So understanding volatility and how to manage it, that's a key part of managing market risk.
So it ties back to those stochastic processes we were talking about before. It's not just predicting whether a price will go up or down, but also how much it's going to swing around in the process.
Exactly, exactly. And then you've got things like correlation, which measures how different assets, how they move in relation to each other. So a good portfolio, a well-diversified portfolio, it's going to have assets that aren't perfectly correlated.
Okay.
So that means, if one investment goes down, another one might go up. And that helps to kind of balance things out, mitigate the overall losses.
This is making me think about my own portfolio and how little I probably know about managing all these different types of risks.
Well, that's why financial engineering, it's actually relevant, even if you're not, working on Wall Street or anything like that.
Yeah.
Whether you're investing, running a business, or just trying to manage your own personal finances, understanding risk, it's really crucial.
Okay. And it's not just market risk we have to worry about, right? What about this credit risk thing?
Yeah, credit risk, that's the risk that that somebody who owes you money, a borrower, they're not going to repay a loan or they're not going to fulfill some kind of contractual obligation. And this is a huge concern for, banks and lenders, but also for, investors who might hold bonds or other types of debt securities.
So it's about assessing how likely is it that somebody is going to default, basically, on their debt.
Exactly, exactly. Financial engineers, they use all sorts of models and techniques to try to evaluate that credit risk, taking into account things like, the borrower's credit history, how financially stable they are, and just the overall economic climate.
Makes sense. Okay, then there's this thing called operational risk. That sounds less about like markets and more about what's going on inside a company.
You're right. Operational risk, that's the risk of loss because of some kind of internal factor. So it could be human error, system failures, fraud, even natural disasters. Think about those stories you hear about a rogue trader who loses billions for a bank, or a computer glitch that, causes a major trading error.
Yikes. Okay, those are some scary scenarios.
Yeah.
And then finally, liquidity risk. What is that one all about?
Liquidity risk, that's the risk that you won't be able to buy or sell an asset quickly enough or at a price that you're happy with. This can be a real problem in markets that aren't very liquid, where there aren't a lot of buyers and sellers. It's like, imagine you need to sell your house really fast, but the market's down. You might be forced to accept a much lower price than you would like.
Oh, okay, so you're kind of stuck with this thing you can't easily get rid of.
Yeah, pretty much, yeah. And that can lead to some big losses, especially if you need to raise cash in a hurry. I think the big takeaway here is that all these different types of risk, they're interconnected, right? And financial engineers need to have this really deep understanding of how they all work together.
Yeah, this is really highlighting, I think, the complexity of financial markets and why it's so important to have people who can really understand all these different moving pieces.
Absolutely. It's not just about like, picking stocks. It's about understanding how the whole system works, all the mechanics behind it.
Right. And speaking of understanding the system, it seems like looking through your research here, you're going beyond just Wall Street. Financial engineering is popping up in all sorts of industries now.
You're absolutely right. The applications of this, they're much broader than a lot of people realize. We're seeing it in insurance, in corporate finance, even in government regulation. These skills, this knowledge base, it's really adaptable.
Can you give us some specific examples of how this is playing out? I'd love to hear how these concepts are being used in the real world.
Sure, let's start with insurance. Insurance companies, they use financial engineering all the time to assess risk, to figure out how to price their policies, and to manage their reserves. They have to make sure they've got enough money to pay out claims, but they also need to be profitable and stay competitive.
So it's like this delicate balancing act, making sure they can meet their obligations without taking on too much risk. Kind of like portfolio management, but on a massive scale.
That's a great way to put it, yeah. And then you've got corporate finance. Financial engineers in corporate finance, they're involved in all sorts of stuff, everything from figuring out capital budgeting and, mergers and acquisitions to, managing risk and coming up with hedging strategies. They're basically helping companies make smart decisions about their money.
So they're helping companies use their money wisely and avoid taking on unnecessary risks. What about government regulation? How does financial engineering fit into that?
Well, financial engineers, they actually play a key role in developing and implementing a lot of the rules that are supposed to, promote financial stability and protect investors. Think about the Dodd-Frank Act that came after the 2008 crisis. A lot of the stuff in that law was designed to address these, systemic risks that were exposed by that whole meltdown. And financial engineers, they were really instrumental in developing those regulations.
That makes sense. They're using their understanding of the financial system to try to design rules that prevent future crises. It's like they're the architects of a safer financial system.
That's a great analogy. They're trying to, use their knowledge to build a more resilient, more stable financial world.
That's pretty amazing to think about the far-reaching impact of financial engineering. It's not just about making money, it's about shaping the whole financial landscape.
Exactly. And that's a big part of what makes it such a fascinating and important field.
All right, so we've talked a lot about the concepts, but I got to go back to those formulas you were highlighting earlier, especially when you were talking about options pricing. I know we can't get too deep in the weeds here, but can you give us a little taste of, what those formulas are all about? What are we even looking at there?
Well, I mean, since we've been talking about black skulls, let's look at that formula. It might look a little intimidating at first glance, I know, but it's really just a way to express the relationship between a few key variables that determine, how much an option should be worth, what its price should be.
Right.
You were deep diving into these very models, so I'm sure this will be a familiar territory for you.
Yeah, I was particularly interested in the practical application. Like, how do we actually use this stuff?
Right.
Can you kind of break down what the Black Scholes formula, what it actually takes into account?
Sure. So it looks at the current price of whatever the underlying asset is, the strike price of the option, that's the price you can buy or sell it at, how much time is left until the option expires, the risk-free interest rate, and then that volatility we were talking about before, the volatility of the underlying asset. Plug in all those numbers, and you can calculate, at least theoretically, what the price of the option should be.
So it's kind of like a recipe where each ingredient represents the different factor that's going to influence the final price.
Yeah, that's a great way to put it. And just like with a recipe, if you change one of those ingredients, it's going to affect the final outcome. So for example, if the volatility of the underlying asset goes up, the price of the option, generally speaking, it's going to go up too.
Makes sense.
Yeah.
It's amazing to see how these complex mathematical formulas can be applied to something as tangible as, buying and selling options. It's like this bridge between abstract theory and actual real world financial decisions.
Exactly. That's really what financial engineering is all about. It's about using, these sophisticated mathematical tools to understand and manage and sometimes even, exploit the complexities of the markets.
This has been an incredible overview of financial engineering so far. We've talked about the quantitative core, all these different ways to manage risk, all the different places where this stuff is being used. And we even got a little taste of those fascinating options pricing models.
Yeah, we've definitely laid the groundwork here.
Right.
And now I think it's time to explore the exciting career paths that are out there for people who are drawn to this field, who are intrigued by it.
Yeah. Let's take a quick breather And when we come back, we'll dive into all those different roles and opportunities that are out there in the world of financial engineering.
Sounds good. So, ready to jump back into this world of financial engineering and all those career paths.
Yeah, definitely. Before the break, we were just about to, dive into all the different roles and opportunities out there. And I bet our listeners pretty eager to hear about all that, especially given all that research they've been doing, all those deep dives into, options pricing and risk management.
But the great thing about financial engineering is that it's so broad. So many different paths you can take.
Okay, so paint a picture for me or for our listener, I guess. Somebody's listening to this and thinking, hey, this sounds like me. I like math. I think markets are fascinating, and I love solving problems. What kind of roles would they be, like, well suited for?
Well, I guess the classic financial engineering role, it's the quant.
Oh, yeah, the quant.
Short for quantitative analysts.
Right, right.
They're the math whizzes behind all those models we've been talking about, the ones who are, figuring out how to price those options and all that.
So if our listeners out there, like, fascinated by stochastic processes and the Black-Scholes model and all that, becoming a quant could be the way to go.
Yeah, it could be a perfect fit. Quants, you'll find them, pricing complex derivatives, designing trading algorithms that operate, at lightning speed, or assessing risk for, big banks, hedge funds, places like that. They're taking these abstract math concepts and turning them into, real-world financial tools.
So it sounds like you got to be, like, intellectually sharp, but you also have to really understand how markets work.
Oh, yeah, for sure, for sure. But the rewards can be pretty big, both intellectually and financially. Then you've got the risk managers, the ones who are kind of like the guardians of financial institutions.
Yeah. Given all your research on risk management, I bet this one's particularly appealing to you. What do those folks actually do, though?
Risk managers, you'll find them at banks, insurance companies, big corporations, all sorts. And basically their job is to make sure the organization is doing everything it can to protect itself from potential losses, right? To keep things stable, keep things healthy for the long term.
It sounds like a lot of responsibility, knowing you're, kind of helping to safeguard a company's financial future.
It's definitely a role where you can make a real difference. And then, for those who might be less into, building models and more into like the fast-paced world of trading, there's algorithmic trading.
Oh, yeah. Algorithmic trading. That's where, like, the computers are the traders, right?
Yeah.
Making all the decisions based on some pre-programmed rules and, like, analyzing the market in milliseconds. It's almost like science fiction.
It really is this fascinating mix of finance and technology.
Yeah.
And the financial engineers, they're the ones designing those algorithms, constantly tweaking them, refining them, trying to, get them to achieve whatever those trading goals are.
Yeah, it's like you're taking the human emotion out of trading.
Yeah.
Getting rid of all the bias and, the gut feelings and all that. Do you think, though, that actually makes things more stable? Or could it actually create new problems, new risks that we don't even, foresee?
That's a great question. It's actually a pretty hot topic of debate in the financial world.
Yeah, I bet.
Algorithmic trading, it definitely brings efficiency and speed to the markets. I mean, we're talking about trades happening in milliseconds.
Right.
But there's definitely, a lot of concern about, like, what are the unintended consequences of all this?
Yeah, what happens when there's a glitch in the algorithm and it, starts making a bunch of bad trades, creates like a flash crash in the market or something?
Exactly. That's one of those, potential risks that that people are really worried about and, trying to figure out how to manage.
Right.
And that's why the financial engineers who are specializing in this stuff, they got to understand, like, not just the technical side of how to build the algorithms, but also all the potential risks,
Yeah.
How could this go wrong?
Right. It sounds like a high-stakes game, but also, like, really exciting if you're, drawn to that, the cutting edge of finance and technology.
It definitely is. And then there are more traditional roles, like the investment analysts, who are really focused on, researching and evaluating different investment opportunities.
I do love a good deep dive into a company's financials. What do those investment analysts actually do on a day-to-day basis?
You can think of them as kind of like the the detectives of the financial world, right? They're poring over all these financial statements, market data, industry reports, trying to figure out, is this a good investment? Is this a bad investment? A lot of them work for, asset management companies, mutual funds, hedge funds, and they're basically making recommendations to portfolio managers about what to buy, what to sell, what to hold on to.
So they're the ones who are like, piecing together all the clues, trying to find those hidden gems, or maybe, spot those red flags before anybody else does.
Exactly. They're constantly, building their investment thesis based on all this research and analysis.
Okay. And then there's structured finance, which, that always sounds like really complex and kind of mysterious. Remind me again, what is that all about?
Structured finance, that's about creating these complex financial instruments, often by like pooling together a bunch of different assets and then issuing securities that are backed by those assets. You mentioned mortgage-backed securities and the 2008 crisis.
Yeah, yeah.
That's a perfect example of structured finance.
Those things were like so complicated and nobody really understood them. And when the housing market crashed, it just like triggered this chain reaction that brought down the whole system.
Yeah, it's kind of a cautionary tale, but it also shows, I think, both the potential and the potential risks of this whole structured finance world. It can be used to, come up with really innovative ways to manage risk and allocate capital.
Yeah.
But it can also get incredibly complex and opaque, and that's when things can go wrong, especially if it's not, properly managed.
It sounds like you got to be like creative and analytical and, really understand risk.
You do. That's why financial engineers, they're so in demand in this area.
Right.
They're the ones who can design these complex instruments in a way that, minimizes the risk, maximizes the return, and, all while navigating all the regulations and everything.
So if you're good at finance and you like, solving puzzles, structured finance could be a good fit.
Yeah, absolutely. It's a field where you can really push the boundaries of financial innovation. And then you've got this whole new wave of financial engineering roles that are emerging in data science.
Oh, data science.
Yeah.
That's a hot field right now in like every industry, it seems like.
Yeah.
What's it doing in finance?
Well, with so much data being generated in the financial world, I mean, it's just this fire hose of information.
Yeah.
There's this massive demand for people who can take all that data, make sense of it, find the insights, the patterns.
Yeah.
Financial data scientists, they're like detectives, right?
Ah.
Sifting through mountains of data, trying to find those hidden clues.
So they're using their like analytical skills to find the signal in all that noise, right? Maybe uncover something that could inform investment strategies or help manage risk in a new way.
Exactly. They're using all these cutting edge techniques like machine learning and artificial intelligence to try to, predict market movements or maybe catch fraud before it happens or even personalize financial products and services.
It sounds like a field that's just constantly evolving, pushing the limits of what's possible with data and with, financial modeling and all that.
Oh, it is. It is. And that's what makes it so exciting. If you're someone who thrives on challenge, who loves innovation, then a career in financial engineering, especially on this data science side, that could be the perfect fit.
This has been such an eye-opening look at all the different careers you can have in financial engineering. And it's clear that it's not just for, the math geniuses, but for anyone who's, got a curious mind, a strong work ethic, and just a passion for figuring things out.
Yeah, you're absolutely right.
It's a field that really blends intellectual stimulation with having a real world impact.
Yeah.
And the chance to really shape the future of finance.
Absolutely.
And we've seen, goes way beyond Wall Street, right? It's impacting, industries and economies all over the world.
That's right.
But all this innovation, it does raise some important questions about, the bigger implications of all this, of all these complex systems that we're building.
That's right. As we keep going deeper into this world of financial engineering, we have to ask ourselves, what are the potential downsides? What are the unintended consequences of all these powerful tools that we're creating?
Yeah, let's take a moment to kind of think about those bigger questions. When we come back, we'll explore how financial engineering is impacting the financial system as a whole, the good and the bad. Okay, so back to this world of financial engineering. We've really gone deep on all the tools and techniques, the potential upside, the potential risks.
Right, right.
But now it's time to kind of zoom out, look at the bigger picture. Like, what does all this mean for, the financial system as a whole?
It's kind of like we've built this really intricate machine, and now we're trying to figure out how it fits into the larger system, right?
Right.
Does it make things run more smoothly, or does it introduce like new vulnerabilities, new weak points?
Exactly. I mean, we've seen how powerful these tools can be, but with any powerful tool, there's always, that potential for things to go wrong, for unintended consequences.
Yeah.
And looking through your research, I mean, there are some definite concerns about how these complex models and algorithms, how they might actually impact financial stability.
Yeah, yeah, that's a big one.
Is it making things more stable, or is it actually introducing like new risks, maybe risks that are harder to see, harder to predict?
It's a tough question.
Yeah.
I mean, you could argue that, yeah, they do improve efficiency. They reduce the chance of human error, right?
Right, like those algorithmic trading systems. They
Yeah.
can like react to things so much faster than any human could.
Exactly, exactly. And all those risk management models, they can, help banks and institutions spot problems, maybe even head them off before they get out of control.
Right, right.
But the flip side is that those very systems that are, designed to manage risk,
Yeah.
they could actually be making the whole system riskier.
Because if everyone's relying on the same models, and then those models turn out to be wrong.
Yeah, then you've got the potential for this like cascading effect, right? One little problem in one corner of the market, and suddenly it spreads everywhere, especially when everything's so interconnected and moving so fast.
It's kind of like what happened with those mortgage-backed securities, right?
Mm.
Those models, they didn't really capture how complex the housing market was, how everything was like, tied together.
Yeah, and because those securities were so widespread, I mean, everybody was holding them.
Yeah.
So when things went bad, the losses just spread like wildfire. And
Yeah.
and you had a global crisis.
Right. So it seems like financial engineering, it's almost like this double-edged sword, right?
Yeah, I think that's a good way to put it.
I mean, it can help us manage risk, but it can also create new risks, especially if we like, trust those models too much or if they're built on the wrong assumptions.
Yeah. And that brings up another big issue that you pointed out in your research, this whole idea of transparency. As these instruments and algorithms get more and more complicated, it becomes harder for regulators, even for the people who are using them, to really understand how they work, what the risks might be.
Yeah, so it's like we're building these incredibly complex financial machines, but we don't always know exactly how all the gears are turning, what might happen if something breaks down.
And that lack of transparency can really erode trust, right?
Yeah.
I mean, if people don't understand how things work, they're less likely to invest, to, participate in the market.
It also makes it like way harder to regulate, right?
Oh, absolutely. If regulators don't understand how these things work, how are they supposed to, keep an eye on the market, make sure investors are protected?
Right, right. So how do you balance that? How do you encourage innovation in this field, but also make sure things are like transparent and stable? It's a tough question.
Yeah, there's no easy answer to that one.
And it's probably just going to get harder as technology keeps advancing, as these tools get even more sophisticated. It makes me wonder if in our quest for more efficiency, more innovation, are we actually making things more fragile, more likely to break down?
That's a valid concern for sure.
Yeah.
And I think that's why it's so important for, for everybody, not just the financial professionals, but for everyone to have at least a basic understanding of how these systems work. What are the potential upsides? What are the potential downsides? Financial literacy, it's more important than ever in a world that's this complex.
Absolutely. The more we understand about all this, the better decisions we can make for ourselves, for our own financial well-being.
It's about giving people the tools, the knowledge to really understand these forces that are shaping the financial landscape so they can participate more confidently, make choices that align with what they, with their values, their goals.
Well, this has been an amazing journey, a real deep dive into the heart of financial engineering. I mean, we've learned so much about the tools, the techniques, the potential benefits, but also, the potential risks of this field. It's just constantly evolving, changing so fast.
Yeah, it really is. And we've only just scratched the surface here. There's
Yeah.
always something new happening in the world of financial engineering. So, staying informed, it's key.
Absolutely. And to our listener out there, keep exploring this stuff, keep digging into those notes you sent us, and don't be afraid to ask those tough questions.
Yeah, that's how we learn, right?
Yeah. Financial engineering, it's not just about numbers and algorithms. It's about how those things are actually impacting our lives, impacting the world around us.
It's about understanding, that interplay of math and technology and human behavior and recognizing that, we all have a role to play in shaping the future of finance.
Couldn't have said it better myself. Thank you for joining us on this deep dive into financial engineering. Until next time, keep exploring.